Hi, welcome to Grand Insights. I'm your host, John Feligno, founder of Grand Life Financial. Today, I'm going to help answer the question, do small business owners need their own retirement plan? Now, the typical response you'd expect to hear from a financial planner is absolutely. However, depending upon your circumstances, a more traditional type of retirement plan may not be optimal. For instance, if you plan to sell your business in the future, it may make more sense to reinvest in your business to help maximize its value, and then you would receive a large nest egg upon the sale. Now, if there's no exit strategy that's going to yield that large payday, then certainly a retirement plan is likely the right option to ensure that you have sufficient savings. So, in order to select the right plan, it's important to start with what you want to achieve. If you want to maximize your savings while also reducing your taxes, there are plans that can do that. If you have employees that need to be considered, and the costs of the plan as well as the administrative responsibilities all need to be taken into account. So let's take a look at some different types of plans. A savings incentive match plan for employees, also known as a simple plan. This allows the business owner and the employee to each make contributions to a traditional individual retirement account, or IRA. So as a business owner, you're both the employer and the employee. Therefore, you have the benefit of making both contributions to yourself. These plans are relatively easy to set up and maintain, and they're not required to conduct annual compliance testing or submit IRS filings. However, the contribution limits are lower than some other retirement plans. So this plan might be appropriate for a business owner that has less than 100 employees, and they prefer simplicity and less administrative duties. A simplified employee pension allows the business owner to contribute to a traditional IRA. However, the employees cannot. So it requires contributions to the business owner and the employee's accounts to be proportional, which means same percentage of compensation. For example, if the business owner earned $300,000 a year and the employee made $55,000, with a 10% contribution, the owner would contribute $30,000 to their account and the employee would receive $5,500. Now, like simple IRAs, these plans are easy to establish and annual compliance testing, IRS filings not required. One unique feature is that contributions can vary each year when your cash flow changes, which may be a good reason to select a SEP IRA. Now, defined contribution plans allow the employee and the employer to contribute to the employee's individual accounts. So the most common is a 401k. These plans are highly customizable, meaning there's different contribution features such as safe harbor, Roth, automatic enrollment, profit sharing, or discretionary match, and they do not require employer contributions. A traditional 401k or a company plan, that's going to help you build more wealth, given the higher contribution limits than a SEP or a simple IRA. You also have the opportunity to contribute more to key employees with the benefit of adding a profit sharing component. In addition, a vesting schedule will help retain talent. Now, one thing to bear in mind is that traditional 401k plans require more of a commitment from the small business owner, as they're going to assume a plan sponsor role, which is a fiduciary responsibility. And that ensures the plan meets standards as required by the Employee Retirement Income Security Act, or ERISA. So when you're evaluating 401k providers, it is important to understand the costs, as they can charge direct and or indirect fees for delivering plan administrative services like asset custody, participant record keeping, third-party administration, and professional investment advice. Now, what's interesting is as much as 75% of small business owners pay plan fees of which they're not aware. So be sure to get clear about the fees and costs associated. A safe harbor 401k is popular with small business owners because they automatically pass the ERISA testing due to mandatory employer contributions, and profit sharing contributions are allowed. So a safe harbor 401k would be appropriate if you have highly compensated employees and you want to provide them with the opportunity to maximize their retirement savings as long as you're committed to making the employer match. Now, if you're self-employed or it's just you and your spouse working together, then an individual 401k might be a good choice. These plans offer the same benefits as a company 401k, but they allow you to save more than a SEP or a simple plan. Now, if you're a small business owner and you haven't saved a lot while you're building your business and investing in that, and you're over age 50, and you have strong profits and steady cash flow, then a cash balance plan might be worth considering. This more popular form of defined benefit plan allows you to make significant tax-deductible contributions that exceed those that are permitted in profit sharing or 401k plans. So this illustration, when combining a cash balance plan and a 401k with profit sharing, it's a great way to accelerate the business owner's retirement savings. Each employee is required to receive a cash balance credit. However, as you can see in this illustration, the owners get the largest percentage. And you get a hefty tax deduction as the bulk of it's going to go into your retirement account instead of paying that to the IRS. If you have any questions, please email or call me, and feel free to send questions that we can consider for future topics. Thanks very much for joining.